Assalamu alaikum to all of you and welcome to the day 4 of the practice to pass session. And a very good evening to all of you from my side. So let's start the session. So if you can hear my voice, please write yes in the chat box so that we can start the session. Okay. So today we are going to discuss about the consolidation topic. It has two basic components. The first one is the consolidated balance sheet. The second one is the consolidated income statement. And also examiner likes the interpretation on consolidated financial statements. So this is one of the core area usually comes in the examination that you have to analyze the financial statements, which is consolidated. So let's start with the first slide. We're going to start the session from the basics. Here's my slides. Yeah, it's here. So day 4, 26 November 2020. Format of the exam, section A, B, and C. We've already discussed this in day 1 and day 2. This is the most important slide that tells us about the passing ratio of this paper. Now, consolidation. Now, what is consolidation? Consolidation means the preparation of financial statements of a group. So when we prepare the financial statement of a group, assuming that it is a single economic entity, it is called consolidation. Group means parent and its subsidiaries. A group can only have one parent company, and you can have as many subsidiaries as you have. So there is no limit for the subsidiary companies, but the group must have a single parent company. And in fact, the parent company is required to prepare the financial statements consolidated. There is no need to prepare the financial statements consolidated on the behalf of the subsidiaries. Okay, subsidiary means an entity that is controlled by an entity, another entity. So subsidiary is a company which has been controlled by the parent company, and parent company is an entity that controls one or more subsidiaries. And control means the power to direct the relevant activities. Power to direct the relevant activities. So IFRS 3 has tells us three basic. IFRS 10 tells us three basic definitions for the control. The first one is the power to direct the relevant activities. Number one, ability to use the power. Number two, and the third one is the involvement in the variable interest. So if you have involvement or you got the share in the variable interest of the subsidiary or the investee, then it means you can control that company. So there are three aspects of the definition. You must have the power, you must have the ability to use the power, and finally, you should be involved in the variable interest of the investee. Okay, I request the management to please upload their fourth handout. I think I haven't sent them. So I request the management to please upload day 4's handout in the handout section. Okay. So an associate is an entity on which we have a significant influence. So there's a clear difference between the control and the significant influence. Significant influence means you have the power to participate in the decision-making process. But the control means you have the full power of that particular entity. So if you are ruling the decision-making of the company, it means that you are controlling. But if you are just participating in the policy-making process, you are just giving your suggestions, then it means that you have a significant influence. Okay. Non-controlling interest, the equity in a subsidiary not attributable to parent. So NCI is actually something. Non-controlling interest is a share of the investment of the parties who does not control the subsidiary company. So the concept of NCI actually exists only in subsidiary company. It has nothing to do with the parent company or the associate company. The concept of NCI only exists in the subsidiary company. So they have got the shares, but they cannot control. Yes, you can download the day 4 handout from the handout section. Now, what about the owning most of the shares? Does it means control? Now, remember this point. It is just general presumption that if you have got more than 50% shares, you can control that entity. But it is possible that you can control an entity by having less than 50% shares. So according to the definition of IFRS 10, the word control has more importance than the shares. So if you have a control over another entity, irrespective of the shares, it might be possible that you got the control at percentage of 10% or 20% or 30% or 40%. So if nothing was mentioned, then we assume that if you have got more than 50% of ordinary shares, then we can control that entity. But it is possible that you have got more than 50% shares, but you cannot control that entity. Okay. So I'm giving you the examples of some of the situations. Now, investments can be in subsidiary. We can have investments in associate, and we can have simple investments, or you can say it is a trade investments. So the investment of the parent or the subsidiary company can be in subsidiary. Parent company can be in subsidiary or associate, or it might be a simple trade investment. So now what is the difference? So when we talk about the shares, so the requirement for this is, general presumption is, if you have got more than 50% ordinary shares, 50% plus, sorry, 50% plus ordinary shares. But if you have got 20% to 50% ordinary shares, then you can say this, it is an associate company. And if you have less than 20% shares, then you can say it is a trade investment. But remember this point, the percentage is not important. The important is the influence. So if you have got the control, then it will be your subsidiary, irrespective of the percentage. If you have got a significant influence, then it is an associate company, irrespective of the percentage. And if you have got the trade investment, that means no control, no influence. That means that even you cannot participate in the decision-making process. Now, what to do with this? If we have got a subsidiary company, then it should be consolidated according to IFRS 3. If we have the associate company, it should be dealt with under the scope of IS 28. And which we have got trade investments, it should be considered in the scope of IFRS 9. This is the portion which we have already discussed in our last class, that the equity investment, that is called the financial assets, under the scope of IFRS 9 should be dealt with or classified either in the fair value through P&L approach or fair value through OCI. So we have two categories for it that we have discussed already. So examiner can ask these questions in a theory from this table. Now, what will be the accounting for this? Accounting. We consolidate subsidiary company. We deal under equity method. All the associates, and we use the fair value method, which could be fair value through P&L and fair value through OCI for trade investments. So examiner can ask you the question from this table. What will be the treatment of trade investments or associate or subsidiary? How it becomes the subsidiary or associate of trade investment? Do remember this, the control for the subsidiary and associate, if you have got quantity of or large quantity of the preference shares, it will not going to matter if you have got preference shares. So you cannot control because they don't have the voting rights. So you cannot control or even have an influence based on the preference shares. Okay. And finally, examiner can ask you the question from this table that if the company has got 80% shares initially, and after some time company has sold half of its shares. So previously, if you have got 80% shares and we have sold half of its shares, then it will become your associate company. So the accounting treatment will be changed after disposal. So previously it will be your subsidiary company, so you have to consolidate that company up to the date of the disposal, and after that it will be considered as an associate company, which should be dealt with the equity method. So do remember this point, that examiner can ask some theoretical question from this slide. Correct. Now, I'm going to ask you the question from this slide. If I have got 50% shares, what will be your answer? if I have acquired 50% shares, then what will be your answers? Please write in the chat box. Now, the first question is you have to identify whether you have got ordinary shares or preference shares. So I'm repeating my question that I have acquired 50% ordinary shares. So will it be my subsidiary? Will it be the associate or the trade investment? I have got only 50% ordinary shares. No, wrong answers. Most of the students are giving the wrong answers. Only few students are giving the right answer. If I have got 50% share, my answer will depend on the level of influence. Whether at this percentage of shares, can whether I'm controlling that company or not, whether I've got the significant influence, whether I've got the no control or no influence. So if I have got no control and no influence at 50% share, then it will be a trade investment. Now, the company will tell you some more details. Telling you some more details. If I have got 50% ordinary shares and we have 4 directors out of 5, then what will be the treatment of this company? We have 4 directors out of 5 directors. So if you have got 4 directors out of 5 directors, that means that you have got the majority of the directors. So when we have got majority of directors, it will be your subsidiary company. Wonderful. It will be your subsidiary company. So if I have got 4 directors out of 5, 3 directors out of 5, 2 directors out of 5, and 1 director out of 5. So this is my option A, option B, option C, and option D. So what you will say about these options? Option A, B, C, and D. So yes, very good, very good. Most of the people are giving the right answers. In these two situations, because we are having majority of the directors, then these two situation, it will be the subsidiary company. And in these two situations, this will be considered as an associate company because you are not in the majority, but still you can participate in the decision making process. But if I have got 0 directors out of 5, but I have got large number of shares, then this option will be considered as a simple trade investment. Trade investment. Okay. Wonderful. Now, some important points for the consolidation. All assets, the first point, all assets and liabilities of the subsidiary should be measured at fair value at the date of acquisition. So we can have fair value adjustment either in asset side or liability side. So usually people expect that the fair value adjustment will be made in the non-current asset section only. But you can have a fair value adjustment in liabilities, or we can have some fair value adjustment in current assets as well, like inventories. The second point, all intangible assets should be recognized for the purpose of consolidation. IS 38 says specifically that you cannot recognize an internally generated intangible assets. But for the purpose of consolidation, all intangible assets should be capitalized. Even if there is a research project of the subsidiary company, it should also be capitalized. Now, third point is related to IS 37. We usually disclose all the contingent liabilities according to IS 37. But for the purpose of consolidation, all contingent liabilities should be considered as a normal liability. So we have to make the provision for this. Next point, the consolidation should be on the basis of control and not on the basis of ownership. That means that you cannot proportionate assets or liabilities. You cannot apply a percentage. For example, if I have got 80% shares of subsidiary company, then you cannot apply percentage on the assets and liabilities. We only apply percentage on the profits distribution. Then next point is similar items should be merged and intercompany balance should be cancelled. If we have similar assets and assets should be added, liability should be added. But if we have some intercompany transactions between the parent and subsidiary, then it should be cancelled. Now, basic steps that we have follow for the consolidation: identify the date of acquisition, reporting date, group structure, area of the consolidation. Then we do some adjustments and prepare net assets at acquisition. Then compute goodwill and CI consolidated reserve. And finally, statement of financial position and OCI. So these are the yes. Some questions from tax. Yes, you can expect questions from the taxation as well. Like they will provide you some unused tax losses. And previously we have discussed in our slide that we have to recognize the deferred tax asset on the unused tax losses. Contingent liabilities we disclose according to IS 37. But for the purpose of consolidation, we have to book it as a normal liability. Research project of the subsidiary should be capitalized irrespective of the director's view. Unused tax losses means the tax losses which is not yet been used for the purpose of taxation. What about IS 16? What to tell you about IS 16? Okay, should we move forward or you wanted to ask anything? Research. I was just telling you that the research of the subsidiary company, because we usually charge research cost as an expense in the income statement, but the research of the subsidiary company should be capitalized for the purpose of consolidation, irrespective of the director's view. Deferred income is recorded in consolidation. What sort of deferred income? Okay, here we have a question for you. You have only 1 minute to solve this question. The time starts now. You have to identify which of the following should be treated as subsidiary. Okay, so mostly there are few students who give the feedback that they are having some issues in theoretical type of questions. So my recommendation for all those students is to, when you are attempting a particular theory based question, try to analyze each and every option. It will increase your database in your mind. So there are few points that you should have to remember when you are attempting theoretical based question, that do a particular complete research on each and every theory based questions, like which of the following should be treated as a subsidy. So you have to identify which of the following is a subsidy and which of the following, if it is not a subsidy, then why it is not a subsidy. So analyzing the first point, the question, the acquisition of 60% of the Zacron's equity share on 1st March 2007. The Zacron activities are significantly different from the rest of the uh, group of the companies, Pulgo group of companies. So do remember this point, that it will not going to matter if the parent or the subsidiary company has different businesses or they involve in different industries. But if you have got 60% shares and nothing was mentioned, then you can say that one is right. I was previously tell you guys that don't send messages on the group. Try to send messages on the chat box. Okay. The second point, the offer to acquire 75% of the intercompany share capital on 1st November 2007. The negotiation were finally signed off during January 2008. So this might be the answer, but the question says to you that it is just an offer to acquire the shares, which has not yet been finalized. So if you are just in a negotiation process, but you cannot have acquired the share, then you cannot control that company. So that's why two is wrong. Now the third one is the acquisition of 45% of the speed equity share capital, but the company is able to appoint 3 out of 10 directors. 3 out of 10 directors mean that you are in the minority. You can just give your suggestions, but you cannot control that company. So that is why 3 is a wrong answer. So what will be the treatment of 3? So 3 is actually an associate company. 2 is nothing and 1 is a subsidiary company. So this is how you have to do the research of all each and every point. If 1 is right, why is 1 is right, and if 2 and 3 is wrong, you should know is that why 2 and 3 is wrong. So if you do theoretical questions like this, you will be very much happy when you're appearing in the examination. You will find the questions very simple. So the approach, you have to change the approach uh, of what you were previously doing. So this is the new approach which I'm telling you. So A is the right answer for this question. Hmm. Chat box. Chat box is, this is the chat box where you are sending the messages. This is the chat box actually. Okay. The next one. This one is again for you. Again a theoretical based question. You have only have 1 minute to solve it. Signed off means that the deal to acquire the company has not yet been done. So the deal will be done in next year. Why 2 is in the subsidy? 2 In number 2, it is saying that we are just giving the offer and the deal is not yet been done. Therefore, you cannot control the company right now, at least in the current year. Yeah, 3 should be dealt with under equity method. Very good. Okay. Now, there are some students who are saying that D is the right answer, but you have to analyze each and every option in order to have a grip on the theoretical based questions. Peter owns 100% of the share capital of the company. The directors are unsure whether the investments are should be consolidated. Which of the following acceptance standards would not be consolidated? Not is very important point. So out of the 4 options given, which of the following should not be consolidated? The first point is Peter decided to sell its investment in Alpha as it's loss making. The directors believe that its exclusion from the consolidation would assist users to protecting the group's future profit. So the answer is wrong. You have to consolidate Alpha company unless you disposed of. So the company has not yet disposed of the Alpha company. It's just the plan. Second, Beta is option. The Beta is a bank, and its activities are so different from the engineering activities to the rest of the group. So if the parent and the subsidiaries are involved in different sectors and different businesses, you still have to do the consolidation. So there is no consolidation exemption on this basis. Delta is located in a country where the local accounting standards are compulsory and are not compatible with the IFRS. If you are working in different countries, having different accounting rules and IFRSs, you have to do the consolidation after doing the adjustments. But Gamma is located in a country where the military coup has taken place and Peter has lost the control. Now, if you have lost the control, that it means the company will not be your subsidiary. So if the company is no longer your subsidiary, then you cannot consolidate that company. So the exemption from the consolidation is only allowed when when you have lost the control of the company. So D is the right answer. And B does not matter what you are. It's a company. It's a company. For investment associate is when we showing working. For investment associate, when we show working for the final figures, we record as investment in SFP. No, we have to report as investment in associate in this SFP. I'll explain the option C again. C is saying that the delta is located in a country where the local accounting standards are compulsory and these are not compatible with the IFRS used by the rest of the world. Suppose the parent company is located in Pakistan and we in Pakistan following the IFRS and its subsidiary is located in USA. So the USA is currently using a different accounting standard, which is US GAAP. So my subsidiary company is making the financial statements based on the GAAP, but the parent company is making the financial statements based on the IFRS. So how we can consolidate these 2 companies? So consolidation says that first the subsidiary companies should send its data to the parent company. Parent company redraft the financial statements based on the IFRS and then parent company consolidate the data of its subsidiary company. But there is no consolidation exemptions if you have different accounting rules and policies. Repeat A. Peter has decided to sell its investment in Alpha. Peter has decided to sell it because the question is Peter has not yet sell the Alpha. because it is a loss-making entity. Even if it is a loss-making entity, you have to consolidate it in the group's financial statements unless you sold that company. If you have sold that company, then you cannot consolidate that company. But if you are still have that company, you have to do the consolidation. So moving on towards the next case. Now there could be 4 to 6 cases of unrealized profit in consolidation. Unrealized profit means the profit which has been earned by the parent company from its subsidiary or subsidiary company from its parent company. This sort of profit should be eliminated when we are doing the consolidation. So consolidation never recognize the profit which we have earned within the group. So there are 2 cases in general: the transactions between the parent and subsidiary, or the transaction with the associate company. And in general, we have got 4 situations. The first case is the parent is selling goods to the subsidiary company. You should know the accounting entry for these transactions. The subsidiary is selling goods to the parent to the associate, subsidiary to associate, associate to parent, and associate to subsidiary. So all of you are required to make the accounting entries in all the 6 cases. I'm giving you 2 minutes. Just make accounting entries in all the 6 cases. What about the subsidies held for sale? Even the subsidies held for sale, you still have to consolidate it up to the date of disposal. Don't ask questions related to the interpretation or ratios topic. Right now, we are focusing on consolidation. Just focus on the consolidation. Tomorrow, we'll be discussing the ratios topic. So you don't need to worry about. Now, accounting entries of what? I'm asking that you are required to prepare the accounting entries for the unrealized profit, which we make in all the 6 cases. Yes. One answer is from the parent to the subsidiary, retain and debit, stock credit. From parent to subsidiary, retain and debit, and stock credit. Then what will be an accounting entry if the subsidiary is selling goods to the parent company, if the parent is selling to the associate company, if the subsidiary is selling to the associate, associate to subsidiary, subsidiary to associate. In all the 6 cases, you are required to make the accounting entries. Okay, let's start. Parent sold goods to subsidiary. First case. Subsidiary sold goods to parent. Parent to associate. Associate to parent. Subsidiary to associate. And associate to subsidiary. So these will be the 6 maximum cases for the analyzed profit. So what will be the accounting entry? Debit, credit. If the parent sold goods to the subsidiary, the accounting entry will be retained earnings debit, stock credit. If the subsidiary company sold goods to the parent company, retained earnings and NCI debit, stock credit. If parent company sold goods to the associate, retained earnings debit, investment in associate credit. Associate is selling goods, retained earnings debit, stock credit. Subsidiary is selling to the associates, retained earnings and NCI and stock credit. Investment in associate credit. Investment in associate. Then retained earnings debit and stock credit. So these will be the 6 cases. The two things is very important. The two important point is very important. Whenever subsidiary is selling goods to someone, then you have to book the transaction into retained earnings and NCI. Similarly, when associate company is buying in these 2 cases, then investment in associate will be credited. Otherwise, in all the cases, retained earnings debit and stock credit. So these are the accounting entries. Is that clear to all of you? Wonderful. Now, how we can report the inventory in the consolidated financial statements. So here we have got the formula. How to calculate the consolidated inventory? Parent stock plus subsidiaries stock plus minus fair value adjustments of subsidiary company minus unrealized profit plus goods in transit. So check this point that we never consolidate associates inventory. So whatever be the adjustments of associate company related to the unrealized profit, it should be accounted for in investment in associate account. If the associate company is buying inventory at a profit, then the adjustment of the unrealized profit should be made in investment in associate account rather than in the consolidated inventory. So in the consolidated inventory, you only have to add the parents and subsidiary stock with fair value adjustments, unrealized profits, and goods in transit. Is that clear? Why A to P does not affect NCI. Associate or the parent company has nothing to do with the NCI. NCI concept only exists in the subsidiary company. So whenever the subsidiary is selling goods to the parent, then you have to do adjustment in the NCI. Okay. Now here is a question for you guys. First, calculate the second one, which is the name Petula company, having four options A, B, C, and D. You are required to calculate the consolidated inventory and apply your answers. Yeah. For the balance sheet, we consolidate the full year's result irrespective of the time period. But for the income statement, we have to do the proportionate consolidation if the time period is less than 12 months. Fair value negative means if there is a downward fair value adjustment. So when we do the fair value adjustment, there might be some upward adjustments or it might be some downward adjustments. Fair value adjustment inventory, yeah, I'm giving you this question in which you will face the fair value adjustment. Okay, what are the fair value calculating inventory? Laptop. So here's a question for you guys. I think there are still some students who have not yet been added in the WhatsApp group. If you are not added in the WhatsApp group, please send me a message on my WhatsApp number. I will share you the link. You only have to click the link and you will be automatically included in the WhatsApp. Secondly, I have got a special plan for those students who got flunked previously. So if you were previously failed in this paper FR, then you can send me the message personally. I will give you the special plan to pass the exam first. And I have a different plan for those guys, those students who are giving the exams first time. So I will give them the plan to follow. In the group, I will share the plan for those students who are the first timers, and for the resitters, it's a different plan. You have to share, you have to send me the message, and I will share the plan with you. Please attempt this question and apply your answer. Okay, share your plan here. Attach the files. So what is the right answer for this Petula acquired 80% of the Sanka ship company on 1st October at this date? What will be the right answer for this one? So let's start the question. Some of the Sanka inventory had a carrying amount of 600 and a fair value of 800,000. So that means that there is a fair valuation adjustment in the inventory. And at the year end, Sanka has sold 70% of the stock. So it remains only 30% of the stock. So 60 plus 3250 plus 1940. So the right answer will be A. So the right answer for this question is A. So how we have solved this question? Parent company's inventory is having a value of 3250 plus subsidiary company is having a value of 1940 plus there is a fair valuation adjustment of 2 lakh, out of which only 30% is still in the warehouse because the rest of the inventory is sold. So the right answer will be 5250. Okay. So the right answer for this one is A. Show the calculations. And here we have the calculations for you guys. Parent inventory plus subsidiary inventory plus fair valuation adjustment. In the particular question, we don't have any unrealized profit adjustment. Now, this question is different. After the acquisition, Penkit sold to this pair. This is a different question. I want you two guys to solve it. Now, inventory should be valued at the lower of cost, and RV. Do remember this point, the consolidation has a different point of view. So when there's a fair valuation adjustment at the rate of acquisition, then it could be an upward or downward fair valuation adjustment in any of the asset or liability. Yeah, is it necessary to take the percentage of the fair valuation adjustment? Yes, because at the year end, 70% of the stock was sold actually. That's why we have to take the remaining 30% stock. But if the 100% of the stock was still in the inventory, then we have to add 200,000 in the closing stock. PURP is not, we don't have any PURP. We don't have any transaction between the parent and subsidiary. Unrealized profit adjustment will be made only when parent company sold goods to the subsidiary or subsidiary sold to the parent. There is no intercompany transaction here in this question. You can see, you can still read the question again. There is no sales between the parent and the subsidiary or the subsidiary to the parent. This is still a fair valuation adjustment of the subsidiary company. It says that at this date, some of the Sanka's inventory had a carrying amount of 600,000, but had a fair value of 800,000. So the inventory should be valued at 800,000. So we have to do the fair valuation adjustment of 2 lakh at the date of acquisition. But because we are calculating the closing inventory at the year end, and it says that 70% of the stock was sold to outside the group, then you have to do the adjustment of the fair valuation adjustment only for the 30%. So this is not an unrealized profit case. Now focus on the Penketh question. You are required to calculate the realized profit in the Penketh and the accounting entry. Okay, it's not Venter, it's actually Spare. It's not Venter, it's a Spare. I think this question has some errors because it does not mention. Packet sold goods to Sphere for 20 million. Packet had 1/5 of this still in inventory. Packet sold goods to the vendor for 15%. All of the inventory. Okay, let's make this question a little bit different. In this question, I'm just giving you some adjustment that Packet has acquired 80% shares in Sphere, and Packet has acquired 30% shares in Venter. So now one for subsidiary and one for the associate. So please try to adjust this one and then do this question. Yes, second sale is to associate. Now, P acquired 80% of shares of Sphere. Actually, it's not Venter. It's just a typing mistake. Okay. How much we sold to the Sphere? Goods with a value of 20 million. And how much we sold to the vendor is 15,000. Markup 25%. Markup. And 1/5 is just an inventory. In the inventory, we have got 1/5 of the stock. 1/5 means 20%. 1 divided by 5. And this in this transaction, we have got 100% inventory. Okay. So now let's start solving it. If the packet sold is fair, means parent company sold goods to the subsidiary company, the accounting entry will be inventory debit stock credit, retaining debit. And if the parent is selling to the associate company, the accounting entry will be retaining debit, investment in associate credit. So now how we can calculate the amount? Unrealized profit in this situation will be let's first calculate the profit in this question. The profit in this situation will be 20,000 divided by 125 divided by 125 multiplied by 25. So 4,000 is the amount of the profit. 15,000 divided by 125 multiplied by 25. Not 20. 3,000. So what will be the unrealized profit in this transaction? Unrealized profit will be the inventory which is still held in the warehouse. So 4,000 into 20%, 800. But for the associate, it will be 3,000 into still 100%, and it should be based on the holding percentage as well. So the accounting entry for this will be retained earnings debit 800, stock credit by 800. And for accounting entry for this situation will be retained earnings debit and investment credit by 900. So I have solved this question. If you people have got any issues in it, you can ask it immediately. Don't ask questions from the income statement right now. Focus on the balance sheet. How you have calculated 900? Now 900 is the 30% amount. So first you have calculated the profit in the transaction. Then for the associate company, you only have to take the share of associate profit. So we have got only 30% share in the associate company. So we can only adjust the analyzed profit up to the extent of 30%. So what I have done, 100% into 30%. 150 is sold or 150 is still held? Had 150 of this unit still held. 150 is not sold. It means, okay, we have still 20% inventory, 80% is sold. No, we don't need to take 80%. We only take 80% when we are distributing. When the subsidy is sold to the parent company, then we have to take 80% in the retained earnings and 20% in the NCI. But only when the subsidy sold goods to the parent company. So is it done? 30% holding of the vendor came in the question. It's actually not mentioned in the question, therefore I have mentioned it in the Excel sheet. Actually, it's a typing error in the question. The question does not tell you about this situation. So I'm giving you the situation to clear the doubts about the unrealized profit in subsidiary and associate. Let's move on towards the next slide. Now, the current account transactions can be between the debtors and creditors, investment loan, interest receivable, interest payable, dividend receivable, dividend payable. All you are required to do is to cancel out all these from the group accounts. So if you have got intercompany receivable and payables, you need to do is to cancel these transactions. Simply, then we have investment and loan case, interest receivable, interest payable, dividend receivable, dividend payable. All these transactions between the parent and the subsidiary should be cancelled out. Is it clear? Yes. No. When we are crediting the stock, then it should be adjusting the stock. But when we are dealing with the associate company, the accounting treatment will be done in the investment in associate. So the adjustment should be made in the investment in associate because we have credited the account of investment in associate. Now here is a formula for the goodwill. Cost of investment means the amount of the investment which the parent company has put into the subsidiary company. That is cost of investment. Then we add NCA the acquisition in it. Less fair value of net assets, and at acquisition we got the value of goodwill at acquisition. So examiner can ask you the question in the examination in which you are required to calculate the goodwill at acquisition or goodwill at the reporting date. So there is a difference of impairment loss between these two goodwills. So if the question clearly states that to calculate the goodwill at acquisition, then you are not required to deduct impairment loss. But when we are preparing the goodwill at the reporting date, then you have to deduct the impairment loss from it. Now, cost of investment could be in the form of cash, like you acquire the shares of the subsidiary company and you pay the amount in cash, or it could be through the share exchange. It could be a deferred consideration. It might be a contingent consideration, or it might be through the loans or debentures. So there might be five type of cost of investments. This is the fair value method for the goodwill calculation. Yes. Title treatment of non-current asset sold. Don't worry about the non-current asset. I'm focus on what right now we are doing. Then when we are finishing the session, you can ask anything. It will be covered later on, non-current assets topic. Focus on what we right now what we are doing right now. Now, when the parent company has acquired the shares in the subsidiary company and pays the amount in cash, then the accounting entry will be cost of investment debit and cash credit. Debit cost of investment, credit cash. But when it will be made through the share exchange, the accounting entry will be cost of investment debit, share capital, and share premium credit. Okay. So in the exam question, examiner might ask you to record a particular transaction which has not yet been recorded. So part of the consideration might be recorded, or the other part might not be recorded in the consolidated balance sheet. So all you need to do is to record the transaction which has not yet been recorded by the parent company. Okay. The consideration might be in the form of deferred consideration. Deferred consideration means that we will pay the part of the consideration in the future. This is called deferred consideration. IFRS 3 says that whenever we have got the deferred consideration, it should be recorded at the present value. Okay. The part of the consideration might be in the form of contingent consideration. Contingent consideration is similar to the deferred consideration, but it is a conditional payment. The basic difference between these two is deferred consideration will be made in the future, but it is an unconditional payment. We will have to make the payments in all the cases. But the contingent consideration, we will be paying the amount in the future, but it will be a conditional payment. Conditional payment means if the particular contingent future uncertain event occurs, then we will have to make the payments. Otherwise, you don't need to make the payments. So it should be recorded at the fair value. And the last one is the cost of investment can be made through the loan. So it will be. Okay. Now what about the subsequent impacts? There is no subsequent impact for this transaction. There is no subsequent impact for this transaction. But there is a subsequent impact for deferred consideration. You have to make unwinding of discount for this transaction. So subsequently, when the time passes and the present value has moved towards the future value, there will be an incremental impact on the liability. This is called unwinding of discount. Unwinding of discount. Unwinding of discount will occur in all the cases when we have calculated a value into its present value. So whenever we have a present value, we will always have an unwinding of discount in the future. Fair value, this value could be changed in the future. So if there is a change on the upward side in the contingent consideration, then accounting entry will be cost of investment debit, CC credit. If the investment in the form of contingent consideration has changed and there is an increase in the contingent consideration. But whenever we have a decrease in the contingent consideration, accounting treatment will be CC debit, cost of investment credit. So this is the subsequent impact of contingent consideration. And if it is in the form of loan, then you have to recognize the finance cost of this loan in the future. So these are the impacts of the cost of investment. DC, deferred consideration, and contingent consideration both are liabilities. Now you can ask anything if you wanted to ask anything about this topic. So there are 5 types of investments. Unwinding of discount means we are moving from the present value towards the future value. So there's a demand to explain the unwinding of discount, assuming that you have to make, I'm copying it now, assuming that you are required to make a payment to the subsidiary company after 1 year. The future value is 5 lakh rupees, assuming you have to make payment to the subsidiary company in the future after 1 year. So this is called deferred consideration, that you have purchased the subsidiary on credit terms and you will have to pay the amount after 1 year. This is called deferred consideration. The accounting says that you have to record the deferred consideration at the present value. So what will be the present value factor for the first year? It will be 0.909. So it should be recorded at 45,4500. This is called the present value. Now, today, assuming today is 1st January 2020, and we have recorded this transaction at this amount. But when we completed this financial year at 2020, the value of this present value will increase from this amount to 500,000. So you have to make the adjusting entry because the time value of money impact has removed, because you have moved from 1st January to 31st December. So when you move forward, the value will increase. So what will be the incremental impact? So you have to take present value into the rate at which you have discounted the value. So you have made a discount at 10%. So the 10% value will be 4545. So this is called the unwinding of discount. So if we add these two figures, this amount plus this amount, so it should be equivalent to approximately 5 lakh. That is approximately equivalent to 5 lakh, because we have taken the factor of 0.909. That's why it's 499,950. There's a difference of 50, but it should be approximately equivalent to 500,000. So as the time passes, you have to increase the value. This is called incremental impact, is called unwinding of discount. This portion is called unwinding of discount, and it will be calculated as a percentage of the present value. And unwinding of discount will always be recognized in the income statement of our balance sheet is retained earnings. Do we deduct or add deferred consideration interest from the present value of deferred? There is no deferred consideration interest. Okay. Please ask anything if you wanted to ask. If you want, I cannot repeat the concepts many times because of the time limitation. You can view the video of this lecture and see the point as many times as you can. Please explain the contingent consideration. After consolidation, okay, the second thing is the contingent consideration. suppose we have acquired a company and we have decided that we will pay you 500,000 in the future, but the condition is that certain targets should be met, then we will make the payment. So it is actually a conditional payment which will be based on some future contingent event. So initially we have recorded the contingent consideration at 500,000, but by the year end we come to know that the value of this 500,000 has increased to assuming 700,000. So it shows that there is an increase in the contingent consideration for 5 lakh to 7 lakh. So there is a change of 200,000 over the period in the contingent consideration. So this is actually an increase in the contingent consideration, which should be recorded as, sorry, I have done a mistake here. Retain earnings debit 2 lakh and contingent consideration credit by 2 lakh. Or if there is a decrease, like we come to know that after a few times that the value of change from 5 lakh to 4 lakh. So if there is a change from 5 lakh to 4 lakh, that means there is a decrease in the contingent consideration. So the accounting entry will be 1 lakh contingent consideration debit and credit 1 lakh. So the impact of the changes in the contingent consideration will always be recognized in retained earnings. I've done the typing error here. I think it's also mentioned here. It should always be adjusted in retained earnings. So please explain 7 lakh. What to explain in 7 lakh? I'm telling you that the value has increased from 5 lakh to 7 lakh. The value has increased from 5 lakh to 7 lakh. Yes, the change in consideration, changes in the contingent consideration will be made annually. So if there is a change in the contingent consideration, so you have to see what will be the current value now. So if it has increased from 5 lakh to 7 lakh, there is an increase of 2 lakh, which should be recognized in the return. But if there is a decrease in the contingent consideration, so it will be recognized by debiting the CC and crediting the return. CC means contingent consideration, deferred consideration, and contingent consideration both are liabilities. So it will be record in the liability section. All students who are having some issues in the contingent consideration must attempt the question peeked from the Kaplan kit. It's very important for them who are having issues with the contingent consideration. Peeked. Okay, let's move on. Now here is a question for you in which you are required to calculate the cost of the investment in note 1 and 2. You are only required to calculate the cost of the investment. Yes, consolidated statement of comprehensive income. Cost of the investment, and please calculate the amount and write your answers in the chat box. Solve both the questions. Zanda and Penkit. Share exchange. Calculate the total cost of investment in both the cases. Yes, is it done? Very good. The people, it's nice to see the people are solving the questions. That's great. Okay, I'm going to solve it. On 1st October 2013, Pankit acquired 90 million shares of Sphere 150, one equity shares. The acquisition was achieved through a share exchange of one share in Pankit for every three shares in Sphere. So for every three shares, we are going to issue one new share for the Pankit. So how many shares we are going to issue to the Sphere company? We are acquiring 90,000 shares of Sphere, and for every three shares we are giving our one new share. So in fact we are paying 30,000 shares, and the value of each share of the Pankit company is 4 rupees. So the cost of the investment will be this amount multiplied by 4, it will be 1,20,000. Additionally, Pankit will pay 1.54 cash on 30th September 2014. 14 means after 1 year, and it is an unconditional payment, and it means it's a deferred consideration. So how much deferred consideration that we are paying? It's 1.54 multiplied by 90 million shares. The amount will be 136,800. So there is a present value factor, discount factor of 10%. The present value of this amount will be future value. The present value will be this amount into 0.909. So we are going to the end of the data. Okay. So what should be the accounting entry for this? Cost of investment debit, share capital, and share premium credit. Cost of the investment debit by 1,20,000. Share capital should be credited with the par value, which is normally considered as $1. So it will be 30,000 into 1, and the difference will be recognized in the share premium account, 90,000. For the deferred consideration, the accounting entry will be cost of investment debit and deferred consideration credit with the present value. This is my present value, and after 1 year, I will charge its unwinding of discount. So is that clear? How do you know that it's 0.909? You can check it. Discount, right? This is the formula for the calculation of discount factor. 1 plus 0.10 raised to the power minus 1. You can see here it's 90.909. This is the formula that we use for the calculation of discount factor. But you don't have to worry about this formula because in the examination you will always be given this formula, the discount rate. So for the at the year end, you have to book the unwinding of discount, which will be the percentage of the present value, 0.10. This is my unwinding of discount. And the total cost of investment that we use for the calculation of goodwill will be this amount plus the amount that we paid for the share consideration. So 245,987 is the amount for the cost of investment. So do you people want to ask anything right now? Entry for 245,987. No, actually 245,987 is the combined amount of the cost of investment. So we have to record it separately. The share consideration is recorded separately and the deferred consideration is recorded separately. How we book the interest? We never book the interest on the deferred consideration. It is actually the unwinding of discount that we have recognized, and which will be the percentage of the deferred consideration. The deferred consideration amount is we have calculated it as 125,987, and the 10% of this will be the unwinding of discount for the first year. So I have taken the 10% here, 30,000. Kindly repeat 30,000. See, in the question that we have acquired 90,000 shares, and we are giving our 1 share for every 3 shares we have acquired of this in the subsidiary company. So the portion will be 1 upon 3. You can write it here like the fraction that we use should be 1 divided by 3. So this is how we calculated 30,000. And each share carries has a share price of $4. So the total cost of investment in shares will be 30,000 into 4, 1,20,000. No, unwinding of discount will go in the income statement. It will be charged as a finance cost. Is that clear? on the closing balance or no? As it is, the question is for this for the 1 year, so there will be no unwinding of discount for the second year. What if the consideration is made after 2 to 3 years? Then it will be the percentage of the closing balance on the deferred consideration. Now, when we prepare the income statement, unwinding of discount will be added in the finance cost. Anything else you wanted to ask from this part? I think the people need a break of at least 5 to 10 minutes to refresh. Explain accounting entry. Which entry you want me to explain? Of share premium. Bank cost of investment debit, share capital and share premium credit. Share capital and the share capital account, the share capital account, we always use the par value. As we are issuing 30,000 shares, the par value of each share is $1. So the amount will be 1,30,000, and the difference will be recognized in the share premium account. Now, what about this one? Deferred consideration. The question says that we are paying 1.54 for every share acquired. 1.54 for every share acquired. We have acquired 90,000 shares into 1.54. It means that will be paying 1,38,600 in the future. And we have calculated the present value. Of this 1,38,600, it will become 125 for the first year. Cost of investment debit, deferred consideration credit. I hope I have cleared the doubts. If you still have any question about this part, you can ask it immediately. The final answer for the cost of investment is 245,987. So let's take a break of 5 minutes. No, the cost of investment is not 1,20,000. 1,20,000 is the value of the shares consideration only. So you have to add all the considerations. Negative goodwill will be added in the consolidated earnings. Yes, negative goodwill will be recognized as an income. So a delicious dinner is waiting for me. So let's take a break of 5 minutes. We'll start a session in a period of 5 to 10 minutes. Take a break, 10 minutes. It's dinner time. Okay, G, I'm back again. Welcome back after a short break. So we have attempted this question, Penkit, acquire 90 billion shares of Sphere. Have you guys solved this question? Zenda company acquired 60% shares of Meta. So if you have calculated the value of the cost of investment, please write yes in the chat box. Cost of investment is 6,400. Cost of investment is 10,800. Different 8,100. Oh, we have already there. Have got three options and different options. 12,1257 is DC. Cost of investment is 120,000, but you're saying the cost of investment 130,000. So DC, DC is actually a part of cost of investment. 1,20,000 is the value of the cost of investment that we have paid in the form of shares, and 125,870 is the value of the cost of investment in DC form. So the total cost of investment will be by adding these two figures, 125,870 plus 1,28,000. These two figures should be added in order to calculate the total cost of investment. We can make a combined entry for these shares in this? Yeah, you can make a combined entry through. That's not a problem. Now, what about the Zenda and Meta? Do you people want me to solve it? Okay. On 1st October 2015, Zenda acquired 60%, 5,400 shares of Meta company. Equity shares by means of the share exchange of one new share in Zenda company for every two shares in acquired Meta company. In addition, Zenda company will pay 0.54 per acquired share in 2016. So the cost of investment again in this question has got two components. First one is the shares consideration. Second one is the deferred consideration. We have acquired 5,400 shares. Now for the share consideration, what we are required to calculate is around 5,400 shares, and we are paying one share in Zenda for every two shares in acquired Meta. So the factor will be 1 divided by 2. Okay. And for each share that we are issuing to the Meta company, the price is 3 rupees per share. So the total amount will be 8,100. Similarly, for each share we are paying 0.54 into this figure 5,400 in the future. So it should be discounted. Do we have a discount factor along with us? No, it's 8%. So what will be the discount factor for the first year? We can use the formula 1 plus 0.08 bracket close power minus 1. So the present value is 2,700. So the total cost of investment should be 10,800. Is it done? The screen is not working. $8,100 repeat. We have acquired 5,400 shares of the subsidiary company, and we are issuing 1 share for every 2 share acquired held. So the fraction will be 1 upon 2. And each share of the parent company has a price of 3 rupees. So the final amount will be 8,100. 2,700 is the present value of the future cash flows that we are paying. Now, what will be the unwinding of discount of this? Unwinding of discount will be this amount into 0.08. That will be 216. Very good. That's right. That unwinding of discount will be 216 for this. Should we move forward? Now, one exercise that we are doing is just write the name of the country in which you are currently in the chat box. Write the name of the country, in the chat box. Pakistan, India, Kenya, Ireland, India, country, Karachi, it's not here, UK, India, Nepal, UAE, Canada, Nigeria, Pakistan, Botswana, Ghana, Nepal, Pakistan, Peshawar. Peshawar is not the name of the country. The city of Pakistan. Kalamesri, Uganda, India, Pakistan. Buffer Buffer is not the name of the country. Afghanistan. Where's the chat box? Okay. I think it's fine. I think there is a student who previously worked in bus as a conductor because he is very frequently taking the name of different areas of Karachi. So, okay, so let's start working on NCI. Let's start working on NCI. Let's start working on NCI. So, how to calculate the NCI for the fair value? So you have to see how much shares the NCI has got and multiply it with the share price of the subsidiary company. So share price of the subsidiary company into number of shares of NCI. By multiplying these two figures, you got the value of NCI. So what will be the value of this NCI? No, no. Zenda acquired 5,400 shares out of 9,000. So the parent company is actually acquired 9,000 shares. Parent company has actually acquired group. Sorry, group has actually acquired 5,400 shares out of total 9,000. So the NCI shares will be the balancing figure. So if the group has acquired 5,400 shares out of total 9,000 shares, the NCI shares will be 3,600. And NCI acquisition can be calculated as number of shares of NCI into the share price of the subsidiary, which is 1.5. So the final answer should be 5,400. Very good. It's nice to see the people are calculating the right figures. Okay. Let's do a question in which you are required to calculate the goodwill. Now this one, all of you are required to calculate the goodwill in this question. Please calculate the goodwill in this question. Now, did you people want me to solve the question, or you have done it? Okay, let me solve the question. The good thing is that we have already calculated the cost of investment of this Zenda Meta. I think previously, what is the value that we have calculated? Yeah, it's 10,800. Cost of investment is 10,800. The NCI is already calculated here. It will be 5,400. So this will be the total amount, 16,200. So for the calculation of the goodwill, fair value of net assets at acquisition should be deducted. Now, how we can calculate the fair value of net assets? It will be the sum of share capital of the subsidiary, share premium of the subsidiary, devaluation reserve of the subsidiary, fair valuation adjustment, and retained earnings of the subsidiary at acquisition. So these are actually the things that you need to add. Now, what is the share capital of the subsidiary? Zenda acquired Meta. The market value of Zenda. Equity share of the Meta. It's 9,000 the share capital. We don't have any balance in the share premium account. There is a downward revaluation. Downward revaluation, fair valuation adjustment of 2,500. And there is an unused tax losses of 1.2 million. For which we haven't given the tax rate. Tax rate is, we are assuming it's, we have to say the deferred tax asset, unused tax losses 1,200. Assuming the tax rate is 0.25, the deferred tax asset will be 300. What about the retained earnings? We have acquired the shares on October, and we have been given the retained earnings on 1st April. April, May, June, July, August, September. So 6 months profit should be added here. So in the post-acquisition period, we have been, there's a loss of 3,000 for the year. For the half year, it will be 1,500. So retained earnings at acquisition will be 8,600 minus 1,500. So now by adding these three figures, we got the value of cost of the investment. Fair value of net assets. So the goodwill at acquisition will be the difference between these two figures. So it will be 2,300 goodwill. Very good. Do you wanted to ask anything from this area? Getty and retained earnings. Tax adjustment. Okay. You should know this. Unused tax losses will create deferred tax asset. When we have deferred tax asset, it will increase the fair value of net assets. Okay, and the cost of the investment is what we have already calculated previously. So that's why I have just taken the value directly. If any errors in the net assets of the subsidiary, then examiner will give you the full marks if you have done any sort of errors. So there will be no errors for the total marks. So errors will be made for each and every single component separately. Okay, so DTA, deferred tax asset, will be calculated on all the unused tax losses. How to deferred tax asset debit, retained earnings credit would be the accounting entry for this. Okay, 7,100. You can see here that the opening retained earnings is 8,600, and in the current year, company has earned a profit of 3,000. But the date of acquisition is the mid of this 3,000, and in the post acquisition in this period, company has suffered a loss. So if I make the timeline, it will be much easier for you guys to understand. The retained earnings on 1st April, 1st April, 1st April 2005 is 8,600, and for the year ended 31st March, after 12 months, 1,006. 31st March 2006, 31st March 2006. This amount, the profit that you have earned in this period till this date, is actually minus 3,000. 3,000 is the loss that we have made in this period. Okay, and the opening balance is 8,000, and this is, and it says that the closing balance of the retained earnings will be this amount plus this amount. This is the closing balance of it. But we have acquired the subsidiary on 1st October. After 6 months, 1, 2, 3, 4, 5, 6, 1st October. So we have acquired the subsidiary company after 6 months. So we have to calculate the retained earnings at this date. So what I have done, the company has earned a profit of 3,000 in the whole year. So I have broken down the loss into the 2 periods. The first year loss will be 1,500. The second year's period, the loss will be 1,500. So I have equally distributed the loss figure. So in the first 6 months, company has suffered a loss. So what will be the retained earning balance in the first 6 months? So opening balance is 8,600 minus this 1,500 value. So at this point, the retained earnings cumulative will be 8,600 plus this loss. So it will be 7,100 at the date of acquisition. Got it? Therefore, tax adjustment. Okay, my first question is, do you people know the concept of unused tax losses? Tell me. Do you people know the concept of unused tax losses? Yes or no? Okay. First, I have to tell you concept of unused tax losses. Unused tax losses. Suppose in the current year we have suffered a loss of 9,000. Remember this point that the tax will be paid to the government when the company has earned a profit. So when we have, yes, when we have losses, then there will be no taxes. Okay. But the taxation authorities allowed you to defer these losses for the future. So suppose it's 2020. So because of the COVID and all of the other things, we have suffered a loss, which is a tax loss of 9,000. Assuming 2021, we have earned a taxable income of 20,000. So the government allows you to adjust this loss with this taxable income. So you don't need to pay the tax, assuming the tax rate is 10%, 20%, and 30%. Corporate tax is normally 30% in countries. So assuming the tax rate is 30%, you don't need to pay the tax on this 20,000, which is 6,000. Instead, you can first adjust this loss and then calculate your revised income, which is now 11,000, and apply tax rate on this 11,000. So instead of paying 6,000 to the government, you are only required to pay 3,300. Okay. So do you think that it is a tax saving for us? Yes, it's a tax saving for us because we are not paying 6,000 tax. We are paying just 3,300. So from where we got the benefit? We got the benefit from this particular unused tax loss. It can be deferred into one first year or second year or third year. It can be deferred into 3 to 4 periods. So usually the tax jurisdiction allows to defer the unused tax losses for the future, and for when it goes in the future, it actually saves our profit, saves our taxes. So that is why accounting says that you have to book a deferred tax asset on this particular amount. So the deferred tax will be based on how we calculate the deferred tax asset. We have got unused tax loss 9,000, so we book the deferred tax asset of. So actually, exactly when you see there is a saving of 2,700 because of this tax loss. So therefore, we recognize deferred tax asset on this tax loss. So if it was a DTL, we would less from the net. Yes, if it was a DTL, then it should be deducted from the net assets. Because net assets means assets minus liabilities. So whenever we have got the assets, its value will increase. And whenever we have got the liabilities, its value will go down. Yes. If there is a tax loss, if you report a loss, no, it's not about the you're reporting. It should be in the books of taxation authorities. If the taxation authorities recognize the tax loss, then they allows you to defer that tax loss into the next period. In Pakistan, you have minimum tax on the revenue. Minimum tax on the revenue is actually, it's not the full and final settlement. It is for the people who are not paying the tax on time. So that's why, and usually they report losses. That's why they have charged a profit of on the revenue. Yes, 2,700 is a deferred tax asset, and it will be recognized as an income because it will save our tax from 6,000 to 3,300. So we actually recognize 2,700 as an income. So do you people understand this concept? Is it clear? Is it clear now? That's good. Okay. Now, IFRS 3 says that whenever you have got the negative goodwill, it should be recognized as an income in the income statement. So negative goodwill will go directly as an income in the income statement. So what will be the answer for this question? Yes, correct to the P&L. It's B. So let's start the practice on the CRQ, constructive response workspace. I request all of you to please open the constructive response workspace where we are going to solve the consolidation question. This is a question with the name Dargent. We all will be doing which 6 months had taken for the pre-retaining. First 6 months. So all of you are required to open the constructive response workspace. The last class, I told you guys how to open it. For those who were not present in the last class, see, I am just writing ACCA FR constructive response. ACCA FR constructive response. Then click on the first link that we have, FR CBE specimen exams. Now we are moving towards the ACCA page, CBE. Here you can see there is a link with the name constructive response workspace. This will be our practice session area. So we'll start working on it. Please click on this link, constructive response workspace. And just click on this link. There will be a separate window open. It's a Pearson's view testing workspace. Now this is the constructive response workspace for the Word document. I'm just clicking on this navigation button, navigator, and we have to select question number 16. These are the spreadsheet related questions. Now this is the space where you can solve the question. So A, B, C, and D. D will be the column, which should be colored with the black color. And we will build a single wall. This side, right hand side, would be used for the workings. And left hand side will be used for the preparation of consolidated balance sheet or P&L, whatever we have. So please open it. And also open the March, June, September exam. If you have opened it already, construct a responsive workspace, just write yes, we can, then we can start the question. Okay, students have opened the construct a responsive workspace. So now just read the question, and I'm giving you just 1 minute to calculate the cost of investment of this question. You only have 1 minute to calculate the cost of investment of this question. Okay, so let's start this question. On 1st January 2006, the Argent company acquired 75% of the Litri equity shares by means of a share exchange of 2 shares in the Argent for every 3 shares in Litri. Shares acquired. On that date, further consideration we also issued to the shareholders of the Litri in the form of $100 8% loan note for every 100 shares acquired in Litri. None of the purchase consideration nor the outstanding interest in the loan interest at 31st March and 6 has been recorded at the date of acquisition. The share price of the Darjan company and the Litri company is 3.2. Always remember this point. It's exam technique or exam tip I'm giving to you. Whenever you see a subsidiaries company share price, then it means that you should require to calculate the NCI. You can see here note number 2. Darjan policies to value the non-controlling interest at the fair value at the date of acquisition. Litri shares price at the date of can be deemed to be representative of the fair value of the shares held by the non-controlling interest. So you will always be given, if you always be given the share price of a subsidiary company, then you should know this that this will be used for the calculation of NCI. So working on it, 20,000 is the total number of shares of electric company and group has acquired 20,000 is the total number of shares. Group has acquired 75% shares. NCI has acquired 25% shares. That means the shares distribution will be in this manner. 75% of the total shares of the electric company and 25% for the, this is how we calculate the total shares. Now the cost of the investment. It is based on two components. It's based on two components. The first one is the loan consideration and the second one is the shares consideration. The two shares 2/3 and each value is the shares consideration and the second one is the loan consideration. For the share consideration, we have acquired 50,000 shares, 15,000, and the percentage fraction is 2/3, and each share is carrying a VAX of 3.2. So we have issued the shares with a value of 32,000. And for the loan instrument, for every $100 loan note, we are going to issue 100 new shares. For every 100 shares, the company is going to issue 100 loan note. The amount will be same actually. So this is the total cost of investment. We're adding this amount plus this amount. Then we use calculate the NCI at acquisition. NCI company has acquired 5,000 shares and each share of subsidiary company is 1.8. So the total value of the cost of investment will be this amount plus this amount. So 56,000 is the value of the total. Yes. So whether there is question in the handout? No, it's not in the handout. You can Find this question in the past paper section. This is a March June 17 attempt was hybrid past paper. Or you can find this question in your Kaplan examination kit. The name of the question is Targent. Now we are going to calculate the fair value of net assets. Less fair value of net assets, net acquisition, it's the share capital, share premium, devaluation reserve, retained earnings, fair value adjustment, fair value adjustment, retained earnings. So usually these are the 4 to 5 areas that we use. Now the share capital has got a value of 20,000. There is no share premium here. Okay, the retained earnings. When we have acquired the shares in subsidiary company, 1st January 2006. So April, May, June, July, August, September, October, November, December. So you have to add 8 months profit in the retained earnings. So 19,000 retained earnings will be 19,000 plus 8,000 into 8 divided by 12. So the amount will be 2433. Two four triple three. Do we have a share premium account balance? No. Now let's see the fair valuation adjustments. We have a fair valuation adjustment at the date of acquisition. There is a decommissioning cost which we have not yet recognized. So you should know this. The accounting entry for this decommissioning cost is asset debit and liability credit. Asset debit and provision credit. So asset debit and provision credit. So asset debit means 4,000 add, provision credit means 4,000 less. So the net impact would be 0 for this transaction. Do we have anything else related to date of acquisition? No. So by adding these figures, we got this value. And finally, the goodwill will be this amount plus this amount. 11,667 will be the value of the goodwill. Do we have any impairment loss in this question? There is no impairment. That's done. If you people wanted to ask anything from this calculation, you can ask. Okay, fair valuation adjustment. Fair valuation adjustment. Actually, for this fair valuation adjustment, there is a decommission cost according to IS 37, for which the accounting interest should be asset debit, provision credit. Asset debit by 4,000, provision credit by 4,000. So asset debit means you have to increase the asset. So that asset will increase by 4,000. Liability credit means liability will be increased by 4,000. So the net impact will be 0 for this. Okay. So this is the explanation for the fair valuation adjustment. Anything else you wanted me to explain? Retained earnings. You can see in the question that the opening retained earnings is having a value of 19,000. You can see the question that the opening retained earnings is having a value of 19,000, and the closing retained earnings, sorry, the profit for the year is 8,000. So opening retained earnings is having a value of 19,000, and the profit for the year is 8,000 actually. And we have acquired the subsidiary company on 1st January. So it means that we have acquired after 9 months. So the 9 months profit of this 8,000, 9 upon 12, should be recognizing the pre-acquisition retained earnings. We've done something wrong here. It's not 8 months. Then April, May, June, July, August, September, October, November, December. It's 9 months. Sorry. It's a counting error. Okay. And 2,000 will be the post-acquisition profit. Post-acquisition profit will go in the retained earnings, and the pre-acquisition profit will go in the goodwill. Now it's clear? If we have an impairment in the question, it will be deducted from the goodwill, and then we calculate the goodwill at acquisition. Post acquisition is just the difference. Out of this 8,000, 6,000 is the pre-acquisition, and the remaining amount will be the post-acquisition profit. So this 19,000 plus 6,000 is the pre-acquisition profit. Yes, post-acquisition profit will be distributed between the group and NCI. So I think it's done. Okay, thanks. Now, after reading these adjustments, right from note number 1 to note number note number 1 to note number 3. Just read these adjustments and try to understand the accounting treatments. Then we will prepare the assets based on these adjustments. Just read the adjustments and do your workings. Then we will start. I'm giving just 3 minutes to see all the 3 notes. Like in note number 2, we have done already. Note number 2 is used for the calculation of NCI. Note number 1 is used for the adjustment of provisions and assets. And note number 3 is for the adjustment of unrealized profit. And we do have a goods in transit adjustment. Word process. Select, go in the navigation bar. This is the navigator on the right bottom side. Just click on the navigation bar. You will be having the options for the questions, and scroll down the and select the spreadsheet any format. So let's start this question. Note number 1. At the date of acquisition, the fair value of the electric assets were equal to the carrying amounts. However, the electric operates a mine which requires to be decommissioning in 5 years' time. No provision to be made for the decommissioning cost by the electric. Present value of the is discounted at 8% of the commission is estimated at 4 million and will be paid for the 5 years at the date of acquisition at the end of the mine's life. So here you have to understand that this cost is actually recognized as a provision according to the rules of IS 87. So what we need to do is to record this as a provision. I'm working on it. Note number 1. So the first entry will be asset debit and provision credit. IS 37 says that it should be recorded at the present value. They have already given us the present value. Now we have to calculate how much time has spent up till now. So from the date of the acquisition, which is 1st January, today is 31st March. So it's been almost 3 months after the date of acquisition. So you have to calculate the depreciation of this asset for the 3 months. 4,000 divided by life of this is 5 years, multiply by 3 divided by 12. So 3 months depreciation will be 200. And for this present value of the liability, we always have to make an unwinding of discount. Unwinding of discount will be calculated as percentage of this 4,000 into what will be the discount factor rate, 8%. 0.08 multiplied by 3 divided by 12. Proportionate depreciation and proportionate unwinding of discount is what we have made the entries. I hope it's clear now for the students. Is it clear? Okay, moving towards note number 2. Note number 2 is for the calculation of NCI. We have already done it, so no need to adjust it further. Note number 3, inventory of the lettering. Who is lettering? Lettering is the subsidiary company. Okay. Inventory of the lettering includes the goods bought from the Dargin for 2.1 million. The Dargin applies the constant markup of 40% when arriving at its selling price. So that means who sold the goods in this situation? It was actually parent who sold the goods. So whenever the parent sold the goods to the subsidiary, the accounting entry will be note 3. Accounting entry will be retain earnings debit and stock credit. The value of the transaction is 2.1 million, but the analyzed profit will be based on 40% markup. So analyzed profit will be calculated as 2100 divided by 140 multiplied by 40. So 600 is the value of the analyzed profit. So retain earnings debit and stock credit for the first one. Then on 28th March 2006, Dargin dispatched goods to the lettering. Its parent who is dispatching goods to the lettering with a selling price of 700. These were not received by the lettering until after the year end, and they have not been included in the above inventory at 31st March. So the company has not yet recorded the inventory. So what will be the accounting treatment? So inventory will be debited and the payable will be credited. So treatment will be inventory debit and payables credit. Having a value of 700. So when we purchase this inventory, we also have to adjust the unrealized profit of this adjustment inventory as well. The unrealized profit will be retain earnings debit and stock credit. So the unrealized profit will be 700 divided by 140 multiplied by 40. So this is the second transaction between the parent and subsidiary. So previously we have 2100 in the inventory. We booked the unrealized profit adjustment, and then the company has not yet received the goods, and consolidation says that if there is a goods in transit, this is called the goods in transit. You always have to assume that this has been received. And if we are receiving the goods from the parent company at a profit, then we have to adjust the realized profit as well. This is the realized profit for the second transaction. So we have two entries for the realized profit here. I hope it is clear to all of you. Does the examiner wants entries or just the final figures? Definitely, examiner might want the final figures. He's more interested in the final figures, but it's better for you to make the entries and do the calculations. Then what? At 31st March 2006, the Argent records show receivable of 3 million. This refers to the equivalent payable in electricity due to the goods in transit. So when the goods in transit has been recorded, the receivable and the payable will be balanced. So what does it mean? In the books of the Argent, this is not required for the examination. The examination was, but I'm just making for you guys to understand the trick. The Argent receivable will be 3,000 and electric payables will be, now it's having a value of 3,000. So what we do, we just cancel out these two transactions. So from the receivables, we have to cancel out 3,000, and from the payable side, we have to cancel out 3,000 amount. And it's not compulsory to make these entries. The most important thing is the answer with proper working. Finally, we have the investment in associate. So before starting the question, we are assuming that we are not getting this in the examination. So don't confuse yourself and don't get panic in the examination. Just leave that adjustment. If you're not comfortable with any adjustment, just leave that adjustment. So we are just skipping this adjustment, and after making the balance sheet, we will again adjust this particular adjustment in the balance sheet. Okay. So let's start with the adjustments. So I'm making the assets. Now the name of the group is Dargent Consolidated Statement of Financial Position as at 31st March 2006. This is a very important area. It's a presentation that you should show this. 3 zeros. No. Dargent. Start it again. Dargent Consolidated Statement of Financial Position as at 31st March 2006. Indian working position level, 3 zeros. Now starting from the assets. Starting first asset is non-current asset. In the non-current asset section, we can see that we have property, plant and equipment, 75,200 and 31,500. So PPE, it's 75,000. You can do working directly in the cell plus 31,500. plus 31,500 plus adjustments of 4,000 that we made minus depreciation of 200 we have done. So the amount will be, make it more presentable, we are making it bold. Goodwill is already calculated here. Just need to take the goodwill from here. It's 11,000. Investment in associates. Suppose we don't know about how to deal with investment in associate. I'm just placing it as it is. It's 4,500. I'm just placing it as it is. 4,000. So these are the total non-current assets of the company. Now moving on towards the current assets. First we take the stock. How many you have here? Inventory, trade receivables and bank. Receivables and bank. It's always simple to deal the bank first. It has 1,200 and 600. 1,200 plus 600 for the bank. What about the trade receivables? 14,700 plus 12,500. It's 14,700 plus 12,500 minus current account balance of 3,000. It's done now. What about the stock? Stock is 19,400 plus 18,800. 19,400 plus 18,800 minus unrealized profit and the goods in transit. The goods in transit is having a value of 700 minus we have two unrealized profits here. The first one is for 600 and the second one is for 200. 600 and 200. Just making it manually. And finally then 200. Now these are the total assets. Even if you skip a particular adjustment, don't take tension, you will only lose 2 to 3 marks at maximum. That's the sum. This is my total assets. To make it more presentable, you can select the formats from here. Told you to select the 6th one. You can see here. Now do you wanted to ask anything? Please do ask. If you wanted to ask anything from the asset side, please do ask immediately so that we can move further. PPE. PPE, I have just added two figures, parent and the subsidiary, plus 4,000 of the adjustment from the note 1 less its depreciation of 200. Yes, it's important to use the formula, otherwise if you just punch the values, examiner will not going to understand it how you have calculated the figures. So you have to give the presentation to the examiner so that he will understand. You can even make the cell reference. Yeah, you will get marks if the total asset figure is not correct due to some wrong adjustment. Yes, you will definitely get the marks of the things that you have done right. You will get marks if the total asset figure is not correct. 3/2. In the literary, which one? 3 by 12? Any question you wanted to ask? Or we should move on towards the equity section. Investment in associate is not we have done it right now. We are just skipping one adjustment. And do remember that the examiner will not going to give you marks on the basis of total assets or liabilities or equity. Each and every component has marks. So if you add just parent and subsidiary, you will get portion of the marks. So there is no marks for the total answers. Adjustment of the receivable and payable is just actually a intercompany balance of 3,000, which is the receivable and payable balance between the two companies. You have to eliminate these balances when we are preparing the consolidation. We acquire literally from 1st January. No, we never proportionate assets. We only proportionate profits, or when we are doing income statement, it will be proportionated. But balance sheet items will never be proportionated based on the time period or percentage. It will 100% be equal. How much we will eliminate from the receivable payable? You can see in the question that it says that the receivable and payable balance is actually receivable shows 3,000. So there is a 3,000 balance which should be deducted from both the receivable and payable. Okay, I can't find the question. It's very easy. Just go in the past papers of ACCA. Select. You can see here different versions are given. Just go on the last one. This one is March, June 17. Just click on this March and 17. You will find this question paper. Yes, we have shown the depreciation of decommissioning asset. I can show you the workings of PPE. You can see here it's parent plus subsidiary plus 4,000 adjustments minus depreciation of 200. Yeah, it's saying that the difference was due to the goods in transit. So when we record the goods in transit, the amount will be balanced. So we have to cancel out the two figures. Why we add 4,000 in the PPE when you cancel? It's I didn't cancel the figures. It's actually the impact on the net assets. It was the impact on the net asset, which was effectively zero. But I didn't cancel the asset and the liability. So asset should be recorded in the asset side and liability should be recorded in the liability side. Okay, working on the liability side. We will work on the equity. The first one is in the equity section. We have got equity shares. retained earnings, we have not yet calculated retained earnings, then NCI with the difference, and then finally non-current liability. So first we do these things in current liability, then we'll move on towards, first focus on the current liabilities. 24,000 plus 16,400. 24,000 plus 16,400 plus 700, the value of goods in transit minus 3,000 current account adjustment. For loan notes, we have 24,000, no, 5,000 loan notes. Loan notes, we have 5,000 words of loan notes plus the loan notes that we have issued, 15,000. So the amount of the loan will be 20,000. Equity shares will be, we have to recognize the share capital as well. Retained share capital, share premium. Equity shares of the parent company is 50,000 plus we have issued, how many shares we have issued? 15,000. 50,000 plus 15,000. The share premium will be the difference. It will be 17,000 in the share premium account. Now, what about the retained earnings and NCI? Retained earnings and NCI. So all you need to do is to calculate these two figures, retained earnings and NCI, then your balance sheet will be balanced. So let's start working on it. Retained earnings of the parent company in total will be 36,000. 36,000. Subsidiary profit in the post-acquisition period will be 2,000 into 0.75, 75%. Minus 200 into 0.75 minus unwinding of discount is 80 into 0.75. Any other adjustments that we have? Parent company sold the goods to the subsidiary company. So we have put the adjustments of 200, I think. Let me check. 600 for this and 200 for this. Minus 600 minus interest on the loan will be 15,000 into 8% into 3 upon 12. Can you calculate it for me? 15,000 into 8% into 3 upon 12. Can someone do the calculation? 15,000 into 8% into 3 by 12, 300. Thank you so much. Now working on NCI. NCI will start from the NCI acquisition, which is 9,000 plus 2,000 into 25% minus 200 into 25. For any adjustment that we made with percentage in the retained earnings will be also be adjusted in the NCA as well. 18 to when we add these figures, sum 28. Share capital in the liability section. We have skipped the provision. Provision is 4,000 plus unwinding of discount 80. So okay. Is there any difference between the two figures? I think we will skip something. 300. Did you skip something related to 300? Let me check. Yes, loan interest. Loan interest is interest payable. Current liability, we have to add the interest payable 300. Now here you can see here that the balance sheet is balanced, and we all knew that we have skipped one adjustments. So even if you skip one adjustment, your balance sheet will be equal. Routine liability. Is it done? So you people wanted to ask anything, you can ask it immediately. Otherwise, it is our last question for today. Tomorrow we will start with some of the workings of investment in associate, and then we'll move on towards the consolidated income statement, and then we have to cover the ratios or interpretation area. What does we added unwinding to the provision? Accounting entry for the unwinding of discount will be retained earnings debit by 80 and provision credit by 80. So that is the reason we have to deduct from the retained earnings, and provision should be added by 80. Any other question from the student side? Please do ask. Anything you wanted to ask? Tomorrow we will start with the consolidated income statement first. Equity share show. Equity share. 50,000 is the total share of the parent company. Plus we have issued 15,000 of the share at par value while we are acquiring the subsidiary shares. Retained earnings calculation. Now, this is the retained earnings calculation. The first one is the parent company's retained earning, then subsidiary company's post acquisition profit into 75% because 25% will be delivered to the NCI. Then whatever adjustment that we made in the subsidiary books should also be adjusted in the NCI. So 200 is the depreciation that we have charged on the decommissioning asset. So it will be, the portion will be transferred to the NCI as well. 80 is the unwinding of discount. It will also be 25% transferred to NCI. 200 and 600 is the unrealized profit figure. We don't use the percentage here because it's the parent company who sold the goods. Therefore, we cannot give the share to the NCI. And 300 is the interest of the loan which the parent company has issued in order to acquire the shares in the subsidiary company. Premium. Okay, let me tell you about the premium. You can see here that we have acquired 15,000 shares at a value of 32,000. So the accounting entry will be cost of investment debit by 32,000, share capital credit with the par value, which is we have acquired 15,000 shares and the remaining will be in the share premium account. What did we skip? We skipped this note actually. This is the note that we have skipped. This is about the investment in associate. We didn't discuss this today, and we have skipped this note and our balance sheet is balanced without even attempting this note. So this is the concept of associate actually, but I think we have already run out of time. So tomorrow we will start with this concept of associate. Then we'll move on towards consolidated P&L. Just a quick question for the consolidated P&L. Then tomorrow we'll focus on the main focus of tomorrow will be on the interpretation. But do remember this, that I have shared a handout on the group. All of you are required to just read that handout first before coming to the next class. SPSC has not been recorded. Yes, the question says that the share capital the company has not recorded. You can see in the trial balance here in the balance sheet section, asset side here, the investment in the letter has not yet been recorded by the parent. So we have to record both the investments, cost of the investments in shares and loan, and we also have to record the finance cost of the loan. Is it done? Can you explain note 3? What to explain in note 3? The first part tells us that the parent company has sold goods to the subsidiary company and it has 2.1 million in the inventory, for which you are required to calculate the unrealized profit and remove the figures. The second part tells us that there are some inventory which the parent company has dispatched, but the subsidiary company has not yet received. So consolidation says that this is called goods in transit. We always assume for the purpose of consolidation that we have received the goods. So when we receive these goods, the accounting entry will be inventory debit and account payable credit. The third adjustment is it says that the detergent company has a receivable balance of 3 million, which is not in line with the payable balance, corresponding payable balance in the subsidiary books. And it says that the difference is due to the cash in transit. So actually it was 2.3 million, which was not balanced because of the cash in transit. So when we receive the goods of 700 from the cash in transit, then both the amount will be balanced and we have to cancel out these two figures from the receivables and the payable side. Consolidated retained earnings. Students want to take the picture. Now this is the working for the retained earnings. If you wanted to take the snap. Second working is for the, why did we minus 3000 from the payables? Because first we have to record the 700 balance because previously it was not balanced. Let me show you. This is the working of NCI. Actually the question is saying that the Dargent has a receivable of 3000, but the corresponding payable is not balanced, which is actually it was 2300. So these two are not balanced. So it is saying that when the electric company will receive the goods from the parent company, its liability will increase by 700. So when it increases by 700, it will be balanced. And now you can cancel out these two figures from the receivable and payable sections. So you can see here that we have deducted 3000 from the receivables and we have deducted 3000 from the payables. Okay, Ji. So thank you so much for your patience and time, and try to do the questions. Exams can have cash flow question in section C. Yes, I have shared my video link of cash flow. So I will not be able to cover this in this session because of the limitation of the time period. So I have shared my cash flow link in the WhatsApp group. You can see the video link and understand the concept of the cash flow from the basic to the expert level. So inshallah, we'll meet you tomorrow at the same time with consolidated P&L and interpretation. So take care. Bye bye, Allah Hafiz, and do very good care of yourself.